So for non-monetary items, this is different. Non-monetary items that are measured in terms of historical cost in a foreign currency shall be translated using the exchange rate at the date of the transaction. So whatever the transaction is, you pick up when that transaction occurred, and that's the rate that you use. Non-monetary items that are measured at fair value in a foreign currency shall be translated using the exchange rates when the fair value is measured. So the dates become important and when these things occur, and we'll have a look at that with the second example. Subsequent to initial recognition, this is a really wordy paragraph, but it actually is quite simple what it means. When a gain or loss on a non-monetary item is recognized in OCI, any exchange component of that gain or loss shall be recognized in OCI. Conversely, when a gain or loss on a non-monetary item is recognized in profit or loss, any exchange component of that gain or loss shall be recognized in profit or loss. Basically, that's saying is if you have a non-monetary item, so property, plant, and equipment, land, whatever it happens to be, you just follow how the underlying accounting works. So if you have a gain on that land and it's been using revaluation and that goes through OCI, you take it through OCI. If it's going down through loss, whether it be an impairment or just a revaluation loss, you take it through profit and loss. You just follow what you'd otherwise normally do. And based on that, we're going to have a look at the second question. This is slightly more complex than what we were doing with profit and loss, with revaluations and impairments before, because we've actually rolled them in together just to demonstrate this point. So Waratah Airlines Limited, an Australian airline, has terminal facilities in New Zealand. This includes land which was purchased on the 1st of July 2011 for 5 million Kiwi. Waratah Airlines Limited adopts the revaluation model for accounting for the land on the 30th of June 2013. The revaluation is undertaken and the land is found to have a fair value of $6 million. So what's important here, again, timelines come into play. So this is the 1st of July 2011, 30th of June 2012, and the 30th of June 2013. This is the purchase date, and this is the reval date. But there is a point in the middle where there is no revaluation occurring. That revaluation is basically happening in New Zealand, looking at the land in New Zealand. So it's just looking at the value, and you can see it because it's in New Zealand dollars. It's a revaluation in New Zealand. So for this point of view, this is when, for fair valuing, this is when the revaluation occurs. So if they're using a revaluation model, this is the bit that you're using and the time that you do. You're not doing a revaluation here, even if the foreign exchange rates have moved. It's not a revaluation at this point in time. So if we look at the purchase, New Zealand dollar, 1 Aussie buys 1.18, 1 Aussie buys 1.27, 1 Aussie buys 1.29. So in each case, the Aussie dollar is getting stronger because it's buying more of the New Zealand dollars. So when we come down to the first week, when we come down to the first year, this bit is a typo that should actually be divided by because it's the direction it is. The 500,000 New Zealand dollars worth of the land is going to be worth fewer Australian dollars because 1 Aussie is buying more New Zealand dollars. So $500,000 worth of New Zealand is equivalent to $4.2 million Australian. So we pick up the land and we pick up cash being paid out because we're just paying for it straight up. Now, I've run out of room up there. Let's do it here. So 4.236,211. Now the thing is, as we move forward into this year, we haven't done a revaluation of the land. And if there may well not be any, there may be indicators of impairment for the land in New Zealand. There may be something going wrong with the land itself. Let's assume that hasn't happened. So the land is just as it was just being used as it was, we don't touch it in that way. There's been an impairment, well, sorry, there hasn't been an impairment test yet. But when we look at the foreign currency rates, the foreign currency rates have moved from 1.18 to 1.27. So the Aussie has strengthened, which means the value of the New Zealand dollar has weakened, and that is likely to be an indicator of impairment, because that should probably be less now. Because if $5 million was worth 4.2, if 5 million New Zealand was worth 4.2 before, 5 million New Zealand is worth much less than that. Now we're making some assumptions here. First of all, what's not an assumption is that's just not correct. The assumptions that we're making here is that there's been an impairment test done because there's been a trigger for it. The other assumption that we're making is the actual land, when they do the impairment test, land itself is no different. So the land is still being carried at $5 million New Zealand. But because the exchange rates have moved, that 5 million New Zealand is only worth 3.9 million New Zealand, or 3.9 million Australian. So the land value from an Australian point of view has dropped from 4.2 to 3.9. Bringing it down, now it's not a revaluation, this is going to be through an impairment, so we debit the impairment loss on the date that happens. So we just look at the date the impairment gets done. Impairment loss of 316, which is the difference. Look, this could be land or it could be accumulated impairment, where for this anyway we're pretty agnostic with it. We then roll it forward, we have a revaluation occurring. So into the final year, at this point in time it's now worth New Zealand 6 million, and the exchange rate has got worse yet again, at least for the New Zealand point of view. So we work out what the value is at that point in time. So we get the fair value, and the fair value is the 6 million times the 1.29, or sort of divided by the 1.2941, and that gives you 4636427. So even though the exchange rate has got worse from the New Zealand point of view yet again, because the actual value of the land in New Zealand has got better, we actually see the land value in Australian dollars go up. So the land used to be valued from an Australian point of view at 3.9. It's now gone up to 4.6. So you can see the difference being about $700,000, which is how much the land goes up by. And that gets picked up with what have we got here? The land going, land going up. Now, if you'd taken this straight through accumulated impairment, then you'd split this between reversing out that accumulated impairment and then picking up the rest through land. But because we did it straight through land, it all goes up here. We pick up the gain or reversal. So we had a loss here. We pick it up through a gain. The ceiling is going to be what it is. Like the ceiling, in a sense, is not, well, we know what it is because it's a non-depreciable asset. Now, if it's a depreciable asset, obviously that starts to cause some additional problems. It's not the case here. So gain on reversal we picked up, and the rest goes through revaluation surplus, which is the 400,000. So we picked up what would happen if we were to do a revaluation model with impairment at the same time, which I know is a step beyond what we did earlier, but it's just to illustrate this point here. I don't think we look too much at these sort of transactions, but it is just to illustrate what's happening there. So, before we move on, the last bit is pretty straightforward. So to finish up,